Okay, hello and welcome to today's session. And today we are going to cover past paper question of MAR June 2023 attempt. That is GINI company. So I'm reading this question. GINI is a listed company that manufactures innovative products for telecom industry. GINI has developed a new product called LP500, which is expected to have a project life of 4 years. 4-year life and product name is LP500. GINI's management has decided that the sale price of LP500 will be $90 per unit. Anything higher than this will dramatically reduce the expected annual sales volume, which is currently forecast to be 20,000 units per year. So sale price will be $90 per unit, and the annual volume is currently forecast to be 20,000 units per year. It's saying anything higher than selling price 90, more than 90 will reduce the sales volume. So there is nothing for us to be concerned about because selling price is 90 and current forecast of volume is 20,000 units per year. Variable cost of LP500 includes the cost of bought-in component X22. The price of X22 has been volatile due to supply problems with manufacturers, and consequently, variable cost per unit is presently uncertain. Management of GINI has made following estimates of the variable cost per unit along with probability. So this is a very easy part, that there are 4 variable costs per unit: 40, 50, 60, 70 with their probabilities. I've taught you multiple times that in this case, you need to find the expected value EV of variable cost, because anything whose multiple options and probabilities given, you need to find the EV. So if selling price and probabilities are given, EV. If variable cost probabilities are given, EV. If fixed cost probabilities are given, EV. So here you need to find the EV. So you can say that the first one is 40 with the probability of 20%, 0.2, plus the next one is 50 with the probability of 0.4, plus the next one is 60 with the probability of 0.2, and the next one is 70 with the probability of 0.2. So the EV of variable cost is going to be 54. If you want me to show the working, here I can show you the working. It's going to be 54 variable cost per unit. Okay. Because when multiple selling prices and variable costs are given, always calculate probability. Incremental fixed cost 300,000 per year. All of the above figures are expressed in current price terms, today's terms. Sale price inflation 5% per year, variable cost inflation, fixed cost inflation 3% per year. Okay. New plant equipment costing 1.5 million will need to be purchased at the start of first year, is expected to have a scrap value of 125,000. In nominal terms, at the end of year 4, tax rate 20% is payable at the end of the year following the year to which it relates. It means arrears. Company can claim tax allowable depreciation capital allowances at 25% per year, reducing balance basis with balancing adjustment in the year of disposal. Working capital 100,000 be required, inflation 3%, and nominal WACC is 12%. Okay, the company's nominal discount rate is 12%. Okay, so you need to calculate requirement 1 full marks expected NPV. I've taught you multiple times expected EV NPV is anything which incorporates expected value, either of selling price or of variable cost. So here it's variable cost and probabilities given. So you can easily find the expected value of variable cost. Okay, you can easily find the expected value of variable cost. And using that will give you expected NPV. If selling price and probabilities were given, you would have calculated to find expected NPV of using selling price probability. If fixed cost and probabilities were given, EV of fixed cost, this is how it works. So important thing is, the first thing we need to make is a capital allowance schedule, which has 3 columns: the year, the capital allowance, and the tax savings at whatever the tax rate is, 20%. Okay. Let's start with this. So there is a 4-year life, 1, 2, 3, 4, and things because of arrears will go till year 5. Okay. So year 1, the investment is how much? 1.5 million, 1,500. Capital allowance 25%. Okay. 375. So net book value becomes 1,500 minus 375. in 2.25, 281.25. Then the net book value becomes 1500 minus 375, that is J3, then J4 into 0.25. Last year, all amount will be charged. So the last year's working would be like this, that in the last year, the net book value figure is 1500 minus J3, J4, J5. So this is the net book value. So all amount has to be charged in this year, but the net book value full won't be charged. This is the net book value, but since this is the last year, full amount will be charged, excluding the scrap value will be charged. So you will do at 6 minus the scrap value. What is the scrap value? 125. Whatever leftover amount is, that will be charged. Okay. And then the tax impact of 20%, it's not in year one. Year two, J3, steric 0.25. This is the savings figure. You can drag it till year 5. Sorry, it's I think 0.2. This we have made a capital allowance schedule, and these things have been discussed multiple times in the classes, that we make a year column, then the capital allowance column, then the tax savings 1, 2, 3, 4. Year one, we take 1500 into 25%, then net book value into 25%, then again net book value into 25%. Then net book value was 632.8125, 1500 less all the appreciation, and then deducting scrap. Tax savings from capital allowances, this is the figure which will be claimed in last year. Now, after that, we go towards NPV. So for NPV, we make columns 1, 2, 3, 4, and maybe we have to go till year 5. Yeah, because of that tax. Sorry, 0, 1, 2, 3, 4, and 5. So first investment comes, the investment is negative 1500. Then the revenue comes. So for revenue, I think we should refer to working 1. Then the variable cost, we should refer to working 2. Okay. So 1, 2, 3, 4. And I'm doing workings of the selling price and variable cost. So selling price per unit is 90 and 5% per year, current price term. So 90 steric 1.05, and this will be dragged. Sorry, it's K11 steric 1.05, and now I will drag it. And the variable cost per unit is 54 per unit. Considering expected value, it's 3% per year. So variable cost per unit is 3% per year. So 54 into 1.03 and K12 into 1.03. You need to drag it, and the units each year are 20,000, 20,000, 20,000, 20,000. Okay, so let's find revenue. It's the selling price K11 into K13 units. Okay, and I will drag it. Variable cost is negative, equals to negative, and K12 steric K13. Then the fixed cost. So fixed cost is expected to be 300,000 per year. So 300,000 into 1.03, it's negative. Then it's negative C13 steric 1.03. And then you can drag it. Okay. Let's take investment. I think I did a mistake here because I should have written units as 20 because I am working in thousands. Sorry for that. Okay, because I'm working in thousands. And this will also be 300. Okay. So because I'm working in thousands, so I've removed 3 zeros. Okay. Revenue less variable cost less fixed cost gives you taxable profit. So taxable profit, let's find out. It's the sum of B10 to B13 and then drag. Okay, you have to pay 20% tax in arrears. So from here, it's C14, steric 0.2. It should be negative. And I can drag it. After tax, there is a working capital investment and working capital recovery. Then there is a scrap value, and then there is tax savings from capital allowances. That would be it, would produce net cash flows. Okay, so for working capital investment and recovery, there can be reference to working 3. Okay, this is a working 1. This is working 2. Now we'll go for working 3 towards the working capital. So when you talk about working capital 100,000 will be required at the start. Okay. So it is required 0. Okay. Negative 100. Okay. That it needs to be increased by 3% per year. So this 100 is of year 1, right? That's why it's installed at year 1 start. So we put it in year 0. Then 3% increase. So K15, steric 1.03, 103. Okay. Now the problem is that 100 is required at the start, year 1 start. So we put it in 0. At year 2 start, you require 103. So you will put it at the end of year 1. Year 2 start means year 1 and 3. Then at the start of year 2, sorry, at the start of year 3 required 106.09. You already invested 1.03. So you will put 3.09. And at the start of year 3, at the start of year 4, you require 109.2727. You have already put 103 and 3.09. So you will take the difference of N16, sorry, N15 and M15. So this will make it 3.1827, but I need to put it negative. Okay, this has been discussed in the class that 100 is required at the start of year 1, so put it in 0. 103 at the start of year 2, so you put it in year 1. 3 only, 100 is already invested. Then 106.09 at the start of year 3, so you put it in 2, 3.09, and then at the start of year 4, so 3.1827. And this is working capital investment, sorry. And then we need to do working capital recovery. So recovery will be, sorry, it's N15 minus M15. And the recovery is going to be the last investment 109.2727. Whatever is invested will be recovered. Then scrap. What is scrap value? 125. After scrap, there is tax savings from capital allowances from year 2. So it's 75. Then 56.25. Then the K6 figure. And finally, the K7 figure. Okay, that would be it. So we will net it all to get the net cash flows. Net cash flows will be the sum of all these cash flows from B14 to B19. And you can drag it. So once you get this net cash flows, you don't need to multiply with discount factor to get present value or NPV. You can simply use the NPV via the NPV function. So you all know what is the NPV function. It's equals to NPV. In that case, it's not a problem. You can multiply it with the discount factor of 12%, get present value and NPV. If you want the short route, equals to NPV, bracket open, the cost of capital 12%, comma, NCF from years 1 to year last. So NCF from year 1 is C20 till G20. Bracket close plus NCF of year 0, that's B20. So simply enter. NPV is 78.21 positive. And this means comment on its financial acceptability. I will write it later. Just a 1 mark requirement that since NPV is positive, so project is financially acceptable. You have got the solution in front of you. Now I will give you time to copy. You can copy this solution, and during the solution, if you have any problems, you can definitely contact me. Okay, I am now pausing it for you to copy. Please start. Now, the comment on financial acceptability is a very easy requirement. It's just one mark that since NPV is positive, project is financially acceptable. Okay, comment on its financial acceptability since NPV is positive, project is financially acceptable. Okay, let's move to the next parts now. I'll briefly discuss how your decision in Part A will help GINI achieve their primary objective. Okay. So what is the primary objective? GINI is a listed company. Okay. The primary objective of any listed company is to maximize profit so that it creates wealth for shareholders. In Part A, the project is giving a positive NPV of 78, which means shareholder wealth and profitability will increase. Hence, calculations in Part A may help listed company achieve its primary objective. And lastly, three limitations of using probability analysis. So there are problems and disadvantages of sensitivity and probability. From in the book reading classes, we have discussed them as well. We can write that probability analysis limitations. An expected value is a weighted average value, not a real value. Hence, decision taken on the basis of expected value is unlikely to be 100% accurate. Probabilities are subjective. Finding probability of each outcome is a time-consuming process, and also probabilities are not accurate. A probability approach only considers risk neutral attitude. Risk seeker, risk averse, they are not considered in probability analysis. So if company management has any other risk attitude, probability analysis fails to consider that. Okay, so you can write this, and that would be it for this question.